Cryptocurrency was supposed to revolutionize the world, break free from the control of traditional financial systems, and empower individuals with financial autonomy. But now, governments around the globe are tightening their grip on digital currencies. Why? What's really driving the crackdown on crypto? In this video, we're diving deep into the reasons why the government is cracking down on crypto, the impact it will have on the industry, and what it means for the future of finance. From regulation and taxation to concerns about security and criminal activity, we'll break down the forces pushing crypto into the spotlight. Strap in, because the world of crypto is about to get a lot more complicated. Let's uncover the truth behind the crackdown on cryptocurrencies. Cryptocurrency started as a wild, decentralized experiment, an alternative to the traditional banking system. It began in 2009 with the launch of Bitcoin, created by the mysterious figure known as Satoshi Nakamoto. The idea was simple: create a decentralized currency, free from the influence of central banks and government control. Bitcoin quickly gained traction, with early adopters and blockchain enthusiasts believing in the potential of a digital currency that couldn't be manipulated by governments or large institutions. Other cryptocurrencies followed: Ethereum, Litecoin, and many others, each promising even more advanced features, such as smart contracts, decentralized applications, and quicker transaction speeds. For years, the crypto community believed that blockchain technology could disrupt the global financial system, offer greater privacy, and create an entirely new economy. But as crypto's popularity grew, so did concerns over how it would fit into the existing financial and legal systems. It didn't take long for governments to start taking notice of the growing crypto market. And their concerns were clear: what happens when a completely unregulated currency starts competing with the national money supply? For governments, the very concept of decentralized money posed several challenges. First and foremost, cryptocurrencies could undermine the power of central banks. When people start using Bitcoin or other digital currencies as their primary form of transaction, central banks lose their ability to control monetary policy, such as inflation, interest rates, and money supply. Governments are responsible for the financial stability of their economies. Allowing people to use unregulated digital assets could create massive uncertainty, destabilize markets, and leave governments with less control. Additionally, the anonymity of cryptocurrency transactions has raised concerns about money laundering, tax evasion, and funding illegal activities like terrorism and drug trafficking. For regulators, controlling cryptocurrencies means maintaining national security and ensuring that their financial systems remain safe, secure, and effective. Crypto's decentralized nature has made it a prime target for criminals. In fact, one of the biggest reasons why governments are cracking down on digital currencies is due to their connection with illicit activities. The anonymity offered by cryptocurrencies makes them a preferred method for illegal transactions. Whether it's money laundering, ransomware attacks, or purchasing illegal goods. On the dark web, crypto has been used to evade law enforcement. Some high-profile crimes have linked cryptocurrency to organized crime syndicates, with criminals using blockchain technology to hide their activities and avoid detection. But it's not just criminals who are taking advantage of the system. The lack of regulation has also allowed fraudsters to scam unsuspecting investors. Ponzi schemes, fake ICOs, initial coin offerings, and rug-pulling scams have run rampant in the crypto space, leaving thousands of investors with nothing. As more crimes are traced back to cryptocurrency, governments are under increasing pressure to implement tighter regulations and crack down on the use of digital assets for illegal purposes. Governments have taken a wide variety of approaches to regulating cryptocurrencies, ranging from outright bans to more measured regulatory frameworks. In China, for example, the government has aggressively cracked down on cryptocurrency trading and mining, citing concerns about financial stability and environmental impact. The country has even banned financial institutions from offering crypto-related services. Meanwhile, countries like El Salvador have embraced Bitcoin, adopting it as legal tender in an attempt to boost their economy and attract investment. In the United States, the regulatory landscape is much more fragmented. The Securities and Exchange Commission, SEC, has been cracking down on crypto exchanges and projects that they believe are violating securities laws. Meanwhile, other agencies, such as the Commodity Futures Trading Commission, CFTC, are focusing on crypto as a commodity. The European Union is working on a unified approach to cryptocurrency regulation with the Markets in Crypto Assets, MiCA, framework, which aims to provide clear guidelines for crypto businesses while ensuring that consumer protections and anti-money laundering standards are met. Despite these varied approaches, one thing is clear: governments are no longer treating cryptocurrencies as a fringe technology. They are taking the matter seriously and working to control and regulate the space. One of the most significant drivers behind the crackdown on crypto is the desire to ensure that digital currencies are properly taxed. For years, the tax implications of cryptocurrency transactions have been murky. In many countries, crypto was treated as a commodity, meaning it could be taxed as a capital gain when sold. However, the rise of decentralized finance, DeFi, platforms and non-fungible tokens, NFTs, has complicated matters even further. Governments are scrambling to catch up with the rapid evolution of the crypto space. The rise of DeFi, where users can borrow, lend, and trade digital assets without intermediaries, has created new challenges for tax authorities. Without regulation, there's no way to track who is making crypto profits and whether those profits are being reported for tax purposes. This leaves governments with massive holes in their tax revenues, particularly in countries where cryptocurrencies have been widely adopted. As governments increase their scrutiny of crypto transactions, they are also looking at ways to make sure that taxes are paid. This could mean requiring crypto exchanges to report customer transactions or implementing taxes on profits made from digital assets. Failure to properly regulate and tax crypto could cost governments billions of dollars. As a result, we're likely to see more aggressive tax policies and enforcement moving forward. The environmental impact of cryptocurrency, particularly Bitcoin mining, is another major concern for governments. Bitcoin mining requires massive amounts of energy, with some estimates suggesting that the energy consumption of the Bitcoin network rivals that of entire countries. Much of this energy comes from fossil fuels, particularly coal, contributing to carbon emissions and climate change. Governments that are pushing for green initiatives and sustainable development are finding it difficult to reconcile cryptocurrency mining with their environmental goals. China, which was once the world's largest hub for Bitcoin mining, cracked down on the practice due to concerns over pollution and energy consumption. Other countries have followed suit, with some even implementing bans on crypto mining altogether.